Your tax refund hits. You check the number. More than you expected. $800, maybe $1,200. For 48 hours, you feel like you can breathe. 2 weeks later, you look at your balance, and it's just gone. Not on one big thing, not on a mistake you can point to, just gone. And you have that specific, embarrassing feeling of not knowing where it went when you were honestly trying this time. This happens to almost everyone, across every income level, across people who are otherwise good with money. And the reason has nothing to do with self-control. But here's the part nobody explains first. The windfall was already spent before it hit your account. That's the actual mechanism, not the 48 hours between deposit and spending, the 2 weeks of anticipation before the money ever arrived. Here's how the fuller picture works. Your brain treats unexpected money as a completely different category than money you earned. Not slightly different, processed by a different internal system with different rules applied to it. Regular income arrives with invisible guardrails already attached. Rent is due. Groceries need buying. The bills are committed. The money has a predetermined shape before you even look at your balance. Unexpected money arrives with none of that structure. The brain registers it not as income, but as opportunity. And opportunity gets handled by faster, looser rules than obligation does. It always has, because that's what it was built for. Researchers who study this call it mental accounting, the way people sort money into invisible categories in their heads and spend from each category by a completely different set of rules. Your regular paycheck is serious, protected money, already partly allocated before you check your balance. The tax refund, the bonus, the cash gift from a relative? The brain files it as bonus money. Same dollar amount, completely different internal handling. Not because of how much it is, but because of where it came from and how it arrived. And the spending rules for bonus money are fundamentally looser than the rules for earned income. That's the core of the problem. So the windfall gets directed toward things that also feel like they belong outside the normal cycle. Experiences you'd been postponing. Upgrades that finally feel justified now that there's extra money available. Purchases sitting on a mental list that's been there longer than you clearly remember putting it there. None of those are bad decisions individually. Together, they absorb the windfall before anything deliberate has a chance to happen to it. And each single decision felt reasonable at the time, which is exactly why this pattern catches people so consistently, including people who can see it coming. But here's the part that actually explains why the money moves so fast, not just where it goes. The moment you know money is coming, an employer confirms a bonus, tax software shows the refund estimate, someone says they're sending something, your brain starts allocating it. Sometimes explicitly, in clear mental sentences. That'll cover the car repair, and what's left can go toward the trip we've been talking about. Sometimes it happens in the background, without a single conscious thought. Just a general loosening, a sense that things feel a bit more affordable. Purchases that felt out of reach starting to feel like reasonable options. Either way, the commitment forms during the waiting period, not after the arrival. By the time the money actually lands in the account, the decisions about it are already largely done. The windfall hits an account where it was already claimed. It was spent before it arrived, and that's not a metaphor. This is precisely why auto transfer advice doesn't fix the problem. Move it to savings immediately doesn't reach the anticipation phase, which is where the actual allocation happens. By the time the money appears, the brain has already completed its accounting. Transferring it to savings at that point feels like relocating something that already had a destination assigned. The resistance isn't laziness or weakness. It's that the internal transaction felt finished before the external one began. The brain already closed the books. There's a second layer inside the anticipation phase that most people never identify. The windfall got spent by a more optimistic version of you, the one who existed during the waiting period, before the money arrived, when it still felt like pure possibility. Anticipation phase spending happens through omission more than through action. The things you stop saying no to, the small costs you absorb without much thought, the standard you raise for yourself before you've announced anything. By the time the money arrives, a new baseline is already in place. The windfall fills a gap that opened during the wait itself. The money was never the issue. The gap was. Most people who watch a windfall evaporate feel shame about it afterward. The specific feeling of having told themselves this time would be different, watching it not be different, and wondering what that says about them. Here's what it says. The system ran exactly as it was designed to. This is one of the most thoroughly documented patterns in behavioral economics. It shows up in people who budget carefully, who invest regularly, who know this pattern exists from having read about it, and who watch it happen to them anyway. The shame is built on a wrong premise, the assumption that the variable that failed was willpower, and the conclusion that their willpower was the defective piece. Willpower was never the relevant variable here. The brain's categorization system was. And that system runs the same way in nearly everyone who encounters a windfall without a deliberate structure already in place to catch it. So here's the reframe that actually changes how you see this. A windfall isn't free money. It's compressed time. The reason it disappears faster than regular income is the same reason any compressed resource disappears faster. It expands to fill everything already waiting for it. A windfall lands in a life that has deferred purchases, delayed decisions, and commitments that were temporarily on hold. It gets absorbed by all of them simultaneously, in a way that metered monthly income never could, because monthly income arrives too slowly to satisfy everything at once. The problem isn't the size of the windfall. It's the absence of a structure specifically designed for receiving a lump sum. And most financial plans are built for managing money, not for receiving it. The question that actually matters isn't, how do I stop spending it? The question is, what does this money need to do that my regular income structurally cannot? Those are different questions with different answers. The first frames the windfall as money that needs protection from you. The second frames it as a tool that's better suited to certain jobs than your regular monthly income is, and asks which specific job that is, before the anticipation phase answers for you by default. Here's what actually changes the outcome. First, intercept the anticipation phase, not the arrival. The real decision point is the moment you know money is coming, not when it lands. Write down the number. Write down what it's for. A specific, named use, committed to before the money appears. Not a general savings intention. Not, I'll figure it out when it hits. A specific destination, chosen during the anticipation phase, before the anticipation phase fills it with something else. Because the decision happens regardless. You make it deliberately, or the waiting period makes it for you in ways you won't fully track. There's no neutral option between those two. Second, give the windfall a job your regular income structurally can't complete. A specific, named gap, not a broad category. The emergency fund that's never quite fully funded. The high-rate debt your monthly budget never quite closes fast enough. The investment contribution you've been meaning to make for the past 2 years. Windfalls are better suited than regular income for closing specific structural gaps, because they arrive as a lump and can close something entirely in one move, which incremental income can't. That's the right job for this particular tool, and most people never use it that way. Third, let a portion be actually free. Plans that allow zero discretion fail because the arrival of money, followed immediately by total loss of all access to it, creates a pressure that consistently leads to abandonment of the whole plan. Setting 10 to 15% aside for completely unplanned spending isn't a concession to failure. It's a structural decision that makes the rest of the plan hold together. A plan you follow all the way through is worth more than a perfect plan you drop by Thursday. Here's what I want to leave you with. Every time you've gotten a windfall and watched it go, you were not the exception. There is no version of everyone else who handles this consistently without a specific system in place. The pattern doesn't sort by income level, or by how much you knew going in, or by how seriously you intended to do things differently this time. It runs on nearly everyone who meets it, without a structure already built to catch it. The vanishing windfall is one of the most common financial experiences there is, and one of the least talked about, because of the embarrassment it reliably leaves behind. The sense that the money was right there, and now it isn't, and that says something about you. It doesn't. The money was right there. The brain was built to spend it. That's the entire story. What's the windfall you most remember? And looking back now, do you actually remember what it went on? Drop it in the comments. And if this one landed, subscribe, because this channel is for the financial patterns that make you feel like the only one, when you are very much not.